In this video, I'm going to show you exactly how to buy your first rental property. No fluff, no hype, just a proven step-by-step system that anyone can follow. Whether you have $5,000 or $50,000 to invest, whether you're looking to quit your job or just build some passive income on the side, I'm about to show you the same strategy that helped me go from 0 properties to a portfolio that generates consistent cash flow every single month. By the end of this video, you'll know how to find deals other investors miss, how to analyze a property in under 10 minutes, and the financing options most beginners don't know about. So if you're ready to stop thinking about real estate investing and actually take action, let's dive in. All right, let's go to the first part of this video. Are you ready to buy your first rental property? I'll be fast on this. I've already made several videos explaining how important diversification is. A house, a property, are real estate investments, and to have a secure life to prepare for crises. The ideal is for your portfolio to have several asset classes, such as stocks, international assets, and fixed income. You can find out more about this in the video on the card. But the golden rule is, before buying your first property, you need to have a considerable amount invested in all of these asset classes. The video on the card will also show how much more or less you should have in each one. And you need to have an emergency fund that covers 6 to 12 months of your expenses. Because if you don't, your mortgage could turn into a huge debt. The second part of this video is how to analyze a property in under 10 minutes. When it comes to analyzing a rental property quickly and effectively, the key is simplicity. You don't need spreadsheets full of complicated formulas or hours spent on deep dive market research, especially if you're just starting out. Instead, I'm going to show you a straightforward approach using just a few critical numbers that will help you determine if a property is a good investment in less than 10 minutes. First, let's quickly look at the 1% rule. This is the initial filter I personally use before diving deeper into any property. It states that the monthly rental income should be at least 1% of the property's total purchase price. For instance, if you're considering a house priced at $150,000, your target rent should be at least $1,500 per month. This rule immediately helps you discard deals that won't provide enough cash flow and focus only on those with clear financial potential. Let's test this with a practical example. Suppose you found a duplex listed for $250,000. Before anything else, you'd ask, can I realistically rent each unit for at least $1,250 monthly, a total of $2,500? Quickly search the local rental listings using websites like Rentometer or Apartments.com to validate market rents. If the answer is no, you're done. Move on. If yes, you proceed to step 2. Now let's check your cash flow. Calculate your net operating income, NOI. Quickly, take your annual rental income and subtract your annual operating expenses. Property taxes, insurance, maintenance, property management, and vacancy. And typically, operating expenses run about 30% to 50% of your rental income, depending on property condition and location. Let's run through a real example. Imagine your duplex rents a total of $2,500 monthly. That's $30,000 annually. If you estimate operating expenses conservatively at around 40%, that equals $12,000. This leaves you with an NOI of $18,000. $30,000 minus $12,000. Next, you want to factor in your mortgage payment. Using today's interest rates, let's assume a 7% annual interest rate on a 30-year fixed rate mortgage. A $250,000 purchase with 20% down, $50,000, leaves you financing $200,000. Your monthly mortgage payment would be around $1,330. You can quickly verify this with an online mortgage calculator like the one provided by Bankrate. Annually, that's about $15,960. Subtracting your annual mortgage payment from your NOI gives you your estimated annual cash flow. NOI, $18,000. Mortgage payments, $15,960. Annual cash flow of $2,040. To assess if this is attractive, look at your cash-on-cash return. You invested $50,000 up front, so divide your annual cash flow, $2,040, your initial investment, $50,000, giving you a cash-on-cash return of approximately 4.08%. Is that good enough? Typically, I aim for at least 8% to 12%, meaning this deal, as it stands, may not hit your target returns. But this quick analysis gave you an answer immediately. Here's how this method works in practice with a real-life scenario. In Columbus, Ohio, an investor I know quickly analyzed a property listed at $160,000. Market rents suggested they could earn about $1,900 monthly. This passed the 1% rule. Monthly rent was 1.18% of the purchase price. With operating expenses around 35%, their net operating income was $14,820 per year. The mortgage payments came out to about $10,080 per year, leaving annual cash flow at $4,740. Their initial investment, down payment, was $32,000, resulting in a cash-on-cash return of roughly 14.8%, an excellent investment. All this took less than 10 minutes to calculate. By mastering this quick analysis method, using the 1% rule, NOI calculations, mortgage estimates, and cash-on-cash returns, you'll quickly and confidently identify great rental opportunities while others are still trying to figure out where to start. This is how you build a profitable portfolio efficiently, one property at a time. Let's move to the third part, the financing options most beginners don't know about. When beginners think about financing a rental property, they usually only consider a standard mortgage. But if you want to accelerate your growth, you need to explore options beyond traditional bank loans, options that savvy investors quietly use every day. One of the most powerful strategies that's often overlooked is seller financing. This is where, instead of borrowing money from a bank, you borrow directly from the property owner. And you might be thinking, why would sellers do this? Well, sometimes they own the property outright and prefer consistent monthly income rather than a lump sum. It can also help them reduce tax liabilities by spreading capital gains over multiple years. Let's put real numbers behind this to understand how it benefits you. Imagine you found a property valued at $250,000. Instead of paying the bank's current market rate, around 7%, you negotiate seller financing directly with the owner at 5% interest. If you put 10% down, $25,000, your loan amount is $225,000. At 5% interest over 30 years, your monthly payment is roughly $1,208. Compare that to a conventional bank loan at 7%, which would be about $1,497 monthly. That's an immediate saving of $289 per month or $3,468 per year straight into your pocket. Over a 5-year span, you've just boosted your returns by over $17,000 simply by choosing smarter financing. Another financing option most beginners never explore is called the FHA multifamily loan. This is one of the best kept secrets for new investors. Here's the deal. The Federal Housing Administration, FHA, allows you to buy a multifamily property up to 4 units with as little as 3.5% down, as long as you occupy 1 unit for at least a year. This option opens the door to investing even if you're starting with minimal capital. For example, let's say you find a fourplex priced at $400,000. Typically, you'd need at least $80,000 down, 20% with conventional financing. With an FHA multifamily loan, your down payment drops dramatically to just $14,000, 3.5%. Even factoring in mortgage insurance premiums, you're still drastically lowering your upfront costs, freeing up thousands of dollars to invest elsewhere. Live in 1 unit, rent out the other 3, and potentially live mortgage-free, or even better, cash flow positive. Also, consider exploring private money lenders, hard money loans. Private money usually comes from individuals within your personal network or local real estate groups, friends, family, or professionals seeking solid returns. Hard money loans, on the other hand, are from specialized lenders who base their financing primarily on the property's value rather than your credit score. Both private and hard money lenders typically offer short-term loans, 6 to 24 months, making them perfect for properties needing renovations. Let's illustrate this clearly. Imagine a distressed property selling for $150,000 but requiring $30,000 in repairs. A traditional bank likely wouldn't approve this loan due to property conditions. A private lender, however, might offer you $180,000, covering both purchase and renovation at 10% interest for 1 year. Once renovated, the property's new appraised value jumps to $250,000. You then refinance with a conventional mortgage at a lower rate, paying back your private lender in full. You've effectively secured a valuable asset with minimal out-of-pocket investment, leveraging other people's money to maximize your returns. Finally, never overlook home equity lines of credit, HELOCs, if you already own your primary residence. A HELOC allows you to tap into your home's existing equity to finance a rental property quickly. Suppose your home is worth $300,000 and your outstanding mortgage balance is $150,000. If your bank approves a HELOC of up to 80% of your home's value, you'd have access to $90,000, $240,000 minus your existing $150,000 mortgage. This is an incredibly effective strategy to instantly access low-cost funds without liquidating investments or savings, allowing you to move swiftly on attractive opportunities when they arise. These financing strategies, seller financing, FHA, multifamily loans, private and hard money lending, and HELOCs, aren't commonly discussed, but they're exactly what smart, experienced investors use to scale their portfolios quickly. Knowing and utilizing these can accelerate your investing journey by years, giving you a significant advantage in building long-term wealth. Okay, this is kind of a bonus topic. I'm about to tell you a truth that few investors know. If you're looking for properties in the same places as everyone else, you're just fighting for crumbs. Pay close attention to this. Zillow, Redfin, these popular websites, they're easy to access, but you're competing with thousands of people Prices go up, your margins disappear. This is not how you build real wealth. The big secret? Off-market properties. I'm going to prove why this changes everything in your financial journey. Let's go to the numbers. It's always through numbers that we understand the truth. Imagine a property publicly listed for $200,000. With multiple offers, it ends up selling for $210,000. Typical in a competitive market. Now, the scenario that separates ordinary investors from those who truly build wealth, you run a direct mail campaign and find an owner who inherited a house worth $200,000. They're motivated to sell quickly and privately. You negotiate and close at $170,000, saving $30,000 immediately. Why is this so powerful? If you finance with a conventional mortgage at 20% down, you're investing just $34,000 instead of $42,000. Instantly, you've reduced your cash outlay by $8,000. But it gets even better. Listen to this. With rental income of $1,500 monthly, that's $18,000 per year, minus annual expenses of around $6,000, your net operating income is $12,000. Now calculate your cash-on-cash return. For the off-market deal, that's $12,000 divided by $34,000 equals 35.3%. For the on-market deal, only 28.6%. This is a massive difference in returns, all from securing a better purchase price. In Montreal, a client secured an off-market property valued at $600,000 for just $500,000, paying an additional $40,000 in fees, totaling $540,000. This resulted in immediate equity of $60,000, a 10% discount on market value. Similarly, in Portugal, an investor directly contacted a homeowner and purchased a single-family home for 30% below market value before it was listed publicly. So how do you find these golden opportunities? Let me give you 3 actionable strategies. First, launch a direct mail campaign. Select specific neighborhoods with good rental demand. Create personalized letters stating you're an investor ready to buy quickly, and be consistent with your mailings. Second, network aggressively with local real estate professionals. Join investment groups, attend meetups, connect on LinkedIn and Facebook groups in your area. Don't just collect business cards, build genuine relationships that bring you deals. Third, use the driving for dollars method. Physically, drive through neighborhoods looking for neglected properties, overgrown grass, damaged roofs, accumulated mail. Note these addresses, find the owners through public records, and contact them immediately. By taking these specific actionable steps, you'll consistently uncover high-potential off-market opportunities that other investors completely miss. Remember, wealth isn't built by following the crowd. It's built by taking smart actions where others aren't even looking. Well, that's it, cousins. I hope you enjoyed it. Stay invested until the next video.